What do you think about the path of rates in 2025 and beyond?
So the question is growth going to stabilize from here, or is it going to lead to a recession? Based upon what I'm looking at and talking with our macroeconomists, I think growth is likely to stabilize. So some of the best advice I got is to take your time. Spend your first 6 months listening and understand the firm you joined. Once you understand it, you can be successful.
You have 3 sets of twins, 7 kids. What does the weekend look like?
The days when my wife is sick, it becomes like a scene from Animal Planet. It's every man for himself, just trying to keep everyone alive. When I think about what it takes to do this job, it's all about making good decisions for our clients and shareholders. Are you getting the right information? Are you getting it at the right time? Do you have the right infrastructure and technology to execute on those decisions?
Today we have Pramod Atluri with us. He's a fixed income portfolio manager based in West Los Angeles. Been with Capital Group 8 years. Welcome, Pramod.
Thank you, Mike.
So Pramod, at Capital Group, we use initials. Your initials are PDA.
Yes.
So in the world of public display of affection, I have a surprise for you on your right. So for those listeners, and we have listeners and viewers, for those listeners, what I just put up on the screen is a picture of Pramod and his wife, Josephine, and Elvis.
And
this is marriage number what? So same wife. I'll make sure everyone in Josephine knows, and she shared this with us, so don't yell at her later. But Josephine gave this to us, but you get married a few times with Josephine.
Yes.
Tell us about that.
This is marriage number 4. So just to give some context, my wife is a recovering wedding planner, an event planner, and she loves weddings. So we have had multiple weddings through the years, and this is number 4 for our 20th anniversary. And she's already planning wedding number 5.
And any idea where number 5 will be?
Number 5, one of our coworkers at Capital Group is from New Orleans. And this person mentioned how for just a couple $100, you can have a wedding parade down the streets of New Orleans.
So that's next.
That is coming up next year.
Can I get an invite?
Next year, October, save the date.
All right, I'm in. All right, let me give you a few numbers and you tell me what they mean. And we're gonna do some personal stuff, then we'll get into the bond market and we'll finish up with some personal stuff. But the numbers I'll give you are 3, 8, 15, and 17. What do they mean to you?
They can mean a lot of things, but that refers to the age of my children.
So you have, and it's, most people listening to that would think you have 4 children who are 3, 8, 15, and 17, but it's not that easy.
It's not that easy.
Tell us how many children come out of those 4 ages.
We actually have 7 kids and 3 sets of twins. So we have a singleton who's 17, and then twin 15-year-olds, twin 8-year-olds, and twin 3-year-olds.
So you must be busy. You are the principal investment officer of this nearly $100 billion flagship bond strategy, and you have 7 kids at home. How do you balance that? How do you manage your time?
Yeah. So honestly, the way to be successful at both of those, whether it's managing the bond strategy or managing the chaos at home, is a lot of organization, a lot of communication, and relying on a team of incredible people. And so at home, you saw my beautiful wife, Josephine, who organizes everything and allows us to be successful in managing that chaos. And then at work, we have an incredible team of people.
So and at work, let's get into that a little bit. You are rare in that you were a lateral hire, like I was. We are both rare. And you joined about 40. Were you 40 when you joined?
Yes.
So how is it integrating? Because most of our investment professionals join very early in their careers, stay 35, 40 years and retire. You joined mid-career. You got a lot left in the tank, but you joined mid-career. How is that integration into capital for you?
Yeah. So, whenever one changes jobs or changes roles, there's always a sense of excitement and nervousness. Like you put pressure on yourself in order to be successful. And in this case, you know you've been successful at another firm that operates a certain way. Will that translate to the new firm? When I think about what it takes to do this job, what we are trying to do, it's all about making good decisions for our clients and shareholders. How does one make a good decision? There's raw materials that you need. And a lot of that is, are you getting the right information? Are you getting it at the right time? Do you have the right infrastructure and technology to execute on those decisions? And when you go from one place to another, how that information flows is very, very different from one system to another. So the big issue with integration for me was trying to understand how capital was organized. Information flows one way in one place, but it flows a different way in another place. And capital is really unique because of the way we're structured and organized. If you're at a firm where it's more hierarchical, where there's one decision maker in a fund, information naturally flows to you. You don't actually have to work very hard because everyone wants their ideas in the portfolio, so it just comes to you. Capital is organized differently. We are a team of investors. A lot of our competitors or peers talk about using a team approach, and they do have a team approach. But ours is structural, right? Ours does not work if the team doesn't work. And because of that, information flows differently, and it takes time to understand how that operates. And so some of the best advice I got from people at Capital, including from you, is to take your time. Really spend your first 6 months, however long it takes, listening and understanding and understand the firm you joined so that you can, once you understand it, you can be successful.
I remember I interviewed you in Boston. We were having coffee somewhere, and I said, oh yeah, it's a little bit unique at Capital Group that the analysts don't really report to the portfolio managers. They're investment professionals, they manage money, and they're your colleagues, and there's no hierarchy. And you sort of looked at me across the table and said, really? And but that really is how it works. And you figured that out. Everyone who comes as a lateral hire takes a little time to figure that out. But you really figured that out. Maybe some because you were an analyst. So you started out as a bottoms-up analyst, and now you marry bottoms-up analysis and top-down macro. Tell us a little bit about your process and how you do that.
Yeah. So I actually spent time as an analyst, both as a bottom-up analyst as well as a top-down analyst. So I have a lot of respect for the value and the risk that both can generate in a portfolio. And how you put those two together is really the magic of how you could create a portfolio. When I think about how I put the two together, it really comes down to the philosophy that I have, right? Or the goals that I have for what I'm trying to create. I'm trying to create a portfolio that can generate excellent excess returns over a long period of time. So be top quartile versus all of our peers. I want a portfolio that will consistently beat the benchmark, and therefore will beat passive competitors. And I want a portfolio that's really predictable, because I know how clients and shareholders use a core bond portfolio, and they want it to be the ballast of their overall portfolio.
Yeah, not a wild ride. No one's interested in that in a bond portfolio.
Exactly. And so what I'm looking for there then is to build a portfolio that does not lean heavily in one direction or another, right? So if bottom-up investing can generate a lot of return, but with a different set of risks, and top-down investing, whether that's duration and yield curve or sector selection, can generate a lot of value, I want to make sure that no one of those levers becomes so outsized that if you're wrong, you've just completely destroyed your predictability, or you've created a loss that you can't recover from. So in my process in marrying them, I spend a lot of time thinking about what's the opportunity, what's the upside, what's the downside, how is this risk going to fit alongside the other ones, and then trying to size it in such a way that I can generate value from all of them and really keep the aggregate amount of risk down in the portfolio.
So if we looked at a pie chart, an attribution pie chart, and we went in there and said, look at Pramod's excess return over the last decade, you'd have a lot of different colors on that pie chart.
Mm-hmm.
You know, there might be duration and curve and credit. So you don't have just one lever that you rely on to generate excess return for clients. That pie chart is going to look like a lot of different pieces.
That's absolutely right.
Good. And then try to bring that back to conviction, because you are someone who does have conviction in your ideas, which is excellent. It's what makes you really good at what you do. And then diversification, because sometimes when people hear high conviction and passionate about a smooth ride in diversification, talk a little bit about how those two work themselves out in the portfolio. How does that manifest itself?
Yeah. So I am someone who spends a lot of time with our analysts, right? I want to really understand what are all the themes and all the opportunities that our analysts are seeing, both at an individual particular issuer of a bond level, as well as what's going on with the central banks and what are the opportunities we're seeing in duration. When you spend a lot of time with investors, with the analysts, you get a sense for where do the analysts themselves have a lot of conviction and where is there less conviction. And that informs my own level willingness to take risk. Now, when I'm putting things into a portfolio, putting investments into a portfolio, I'm very careful about sizing. Sizing is an art more than a science, but I've tried to turn it as best I can into a science, where I have a clear goal that I'm trying to generate a certain amount of excess return per year. And if I have a lot of conviction, or if an investor has a lot of conviction, they could choose to go well above that level of excess return. They could try to shoot for 2 or 3 or 4 times that level of excess return. I, on the other hand, will try to hit that excess return and reduce the amount of risk, right? So I'm not looking to try to generate 2, 3, 4 times my target. If I have a high level of conviction in something, I will make it a larger risk in the portfolio, but I start reducing risk in some of my lower conviction ideas on the other side of it.
Yeah, and part of the reason I'm guessing is when you try to aim for 2, 3, 4 times that excess return, it can work both ways, and it gets back to your predictability.
Absolutely. I'm very conscious that in my career, I have seen lots of investors, brilliant investors, and incredible track records, who at times get overextended, and then the world and the market is very unpredictable.
Right.
And you can't protect yourself against everything. And I don't want to ever be in a position where I am exposed to something that no one saw coming and it would create a loss that couldn't be recovered from.
Great. So let's pivot to interest rates now. Post-global financial crisis, we had this really long period of zero interest rates in the US, negative interest rates outside the US. There was this attempt at normalization of policy, and then we had COVID, and we went back to zero. And that created a lot of inflation. So the Fed had a hike, not a little bit, but a lot, 500 basis points over, I guess, about a year. And now the Fed's begun to cut rates. The market would suggest by its pricing that the Fed might be around 3% at the end of 2025. In your view, is that about right? A little high, a little low? What do you think about the path of rates in 2025 and beyond?
It really comes down to economic growth, right? When we look back over these last couple of years, inflation has come down. That has been a really great success story for the Fed and for actually all global central banks. Now, the Fed and other central banks are shifting their attention back to growth and supporting growth. What's been clear for the last year or so is that growth is slowing. It's coming down from the really strong growth we saw after the COVID recovery. So the question is growth going to stabilize from here, or is it going to lead to a recession? Based upon what I'm looking at and in talking with our macroeconomists, I think growth is likely to stabilize.
So you're a soft landing person.
I'm a soft landing person. I think that while growth is definitely slowing, there doesn't seem to be any really large excesses in the economy where a certain sector is having a negative outlook. And in fact, some of the sectors that have been weak, whether that's commercial real estate or some of these other sectors, are actually poised to benefit from Fed cuts. So if the Fed does cut to 3% or something like that, I think that's going to lead to more growth. And that by itself is going to reduce the amount of cuts the Fed's going to have to do. It's a very recursive thing. I think 3% is a little bit low. Maybe it's 3.5%, but it's in the ballpark.
You're in the 3 to 3.5% camp, sort of at the end of 25.
That's right.
Yeah, and I think that's reasonable. I'm going to use an alliteration term, and it's one of yours, and I want you to explain it to folks. Multiple mental models. Tell us about that. How do you use them? What are they, and how do you use them in your process?
Yeah. So I spoke a little bit about having seen lots of investors in my time, right? I've been doing this for a number of years now. And what I've seen is that there are some investors who really have a strong view for how the economy works. They could have a view of monetary policy works through the money supply effect, or they can have a view on globalization. They have a view on how the economy works, how monetary policy works, et cetera. And as I've seen the economy, as I've worked in the markets now for several years, what I've seen
25 years, about
25 years, I've seen that there have been different regimes. There are times when you will have a view for how the economy works or how markets are working, and then all of a sudden it shifts. So the great financial crisis, everyone looked at valuation one way, and then after the great financial crisis, it completely shifts and things go in a different way. Those shifts become great sources of volatility in the market. And one of the things I tried to do in my time is spend a lot of time looking at economic history, learning from different crises, learning the history of monetary policy and the Federal Reserve. And what that's taught me is that there are a lot of different ways to look at inflation. There's a lot of different ways to look at monetary policy. There's a lot of different ways to look at valuation for anything. And I believe that this changes over time. And in order to navigate the market successfully, for me, it's important to try to understand what is the economic model, the mental model that's in fashion at the time. So one of the things I try to do is work with our analysts, work with our colleagues to understand how that's all working today. When I have confidence that it seems to be reflecting the markets, I will invest in that way. And then all of a sudden I'll notice that it stops working. It's inevitable. Sometimes these models will work for a year. Sometimes it works for a month. Sometimes it works for days. Ultimately, though, it stops working. It's one of the reasons why quantitative models often don't work, because they're trained on history, but history is not a static thing. It keeps changing and it keeps shifting.
So you don't get stuck on this rules approach. I have these 3 rules. Whenever this happens, I always do this. You sort of iterate your own process over time as the markets change.
Absolutely, right? An example of this is the yield curve, right? The yield curve, whenever it inverts, for the last 40 years, that's predicted a recession is coming. I, on the other hand, looked at that and said, but this time is different. You know, the famous thing you say before everything falls apart? This time is different. I actually believe that the underlying factors in the economy have changed. That during all of those last times, those were in times when inflation was not an issue. Inflation's super high now, and so this time the yield curve is saying something different. And so because of that, I operated and I did something different in the portfolio.
And you were right. I mean, the yield curve was significantly inverted for an extended period of time, and we're headed towards more of that soft landing. So you're right. You talk about reading, and this is where I'll get into the office treasure hunt. In your office, and I put it up on the screen for those who are watching, and for those who are listening, Pramod has a very long list of books. And you have 50 books. One of the things I was shocked about is the font size. It's super small. But tell us about this 50 book reading list that's on your desk. You have it in a stand. I took it out and I have a printed copy of it. But what's on the reading list and why do you have it?
Yeah. So one of the things that I did early in my career is I realized I'm sitting next to colleagues who've been in the markets for 20, 30, 40 years, and I'm an eager person trying to figure out how to add value. And I didn't know how to do that when everyone else knew so much more than me. So the advantage I did have was time. Early in your career, you don't have 7 kids, you're not,
Right.
managing in a large portfolio. Yeah. You have a lot more time. And so I use that time to learn about economic history, learn about financial history, learn about all the mistakes that have been made in the past so that hopefully I won't make those same mistakes in the future. As I did that, I just kind of kept track of all the different things that I read and which are the things that I thought were most valuable. And now that I'm at a later point in my career, I have a lot of young analysts and new hires who are facing the same dilemma. How can they learn? How can they add value? And I found there's no one great book to teach you how to be a fixed income investor. There just isn't.
Right.
And so this was my attempt at coming up with, what did I do, right? What were the things that helped me in my career at an early stage? And I actually, this list in my office, I actually run a mini library out of my office. And so I have most of those books in my office where colleagues can come and borrow a book and just kind of let me know.
So does everyone return them?
There's definitely a few that are missing.
Do you want to call them out on this podcast today, or is that? No, that's helpful. And I know you're a reader, and I know a lot of people have benefited from that. Something you said about mistakes. We always learn from our mistakes. Point one out to us. Where did you make a mistake where it didn't help clients, obviously, but it helped your long-term process and how you think of things? What was one of those examples?
Yeah. So I think when I look back on my investing career, the areas that will periodically lead me to make a mistake are when I try to deviate from my process. I actually have a pretty disciplined process. It sounds pretty straightforward. When valuations get cheap, you add risk. And when valuations get rich, you reduce risk. It sounds super simple, but in practice, it's hard.
Right.
Because when things become cheap and more attractive, the world looks scary. It becomes very difficult to actually invest based upon.
Yeah, to commit to do that when it feels really bad to do that, you have to still be disciplined.
Exactly. So. And then in terms of how you execute that, there are multiple different levers we can pull. Like we talked about, there's duration, there's yield curve, there's credit, there's structured credit. There's all sorts of different levers one can use. Now, the times when I have deviated from that process because I just have such strong belief that I'm right about the future, that's usually where I will stub my toe, where things will go wrong. And I find that it's, to some extent, a helpful exercise to just remind yourself, you're not as smart as you think you are sometimes. and so it kind of gets you humble again, and it helps me go back to my tried and true process.
It's funny you say that. I was reading this thing that Roger Federer was talking about, saying even the best tennis players in the world only win about 55% of the points.
That's right.
And so you're trying to win the majority of the time, but you have to be humble in that pursuit. What's your investment edge? Tell us about that.
Yeah, I think, related to the investing mistakes, it's the discipline that I have, right? I think discipline is the key in this business because the markets are very volatile at times. They can move in very unpredictable ways. And if you are not disciplined, you can really, really make a lot of mistakes. Now, I have the benefit of having a team of incredible analysts that cover every sector of the fixed income market. And they work with a team of analysts who cover every sector of the equity market. So I have a plethora of great investment ideas for me to pick from. So for me, the value that I add is figuring out how to choose from them, putting them together in a very risk-controlled way, and discipline is the thing that's kept me safe.
So the discipline in your process and how you use the team and construct the portfolio through their best ideas.
That's right.
That makes sense. Looking forward 5 years, break out the crystal ball. When you think about bond market returns, let's use the U.S. core bond market as a proxy. What should we expect? And for all the legal disclaimers, this is just your best idea. You're not sure if this will actually happen in that way, but what do you think will happen in the next 5 years? What will be my annualized return in the core bond markets over that period?
Yeah. So if I look at the core bond index today, it's yielding something like 4.2% plus or minus. That is probably the best estimate for what your 5-year return is going to be. But that assumes that interest rates kind of don't move anywhere, that they kind of stay where they are. In my crystal ball, and I'm looking out 5 years, I think that I'm not calling for a recession today. I'm not calling for a recession tomorrow. I think it's very likely in this next year that the Fed cuts interest rates to 3.5%, in which case that's kind of already priced into the market. But at some point over these next 5 years, I do think there's going to be a recession. It could be caused because of some shock somewhere in the system, whether in the U.S. or abroad. There's lots of things going on. It could come from the deficits that we've had, and that leads to a contraction of fiscal spending, and that ends up leading to weakness in the economy. There are lots of ways we can have a recession.
Economies are cyclical.
Economies are cyclical. And within those 5 years, if the Fed is at 3% and we get a recession in the ensuing couple of years, I fully expect the Fed's going to have to cut again by another couple hundred basis points. That's a very reasonable Fed response or monetary policy response to a recession. If that's the case, every 100 basis points that the Fed cuts will likely yield another 6-ish% return.
Just by owning 6 years of duration, you gain 600 basis points of total return when the Fed cuts 100 basis points.
Exactly. So I think it's very reasonable to imagine getting something like 4.5% return per year over these next 5 years, plus at some point in those next 5 years, another 6 to 12% if we head into some economic
annualized
stress.
returns could be you get your income and then you get some appreciation through the Fed cutting. You could have something like 6% annualized
That's
return over a 5-year period. Okay, we're going to finish out with a couple personal things here. What does the weekend look like at the Atluri home? With 3 sets of twins, 7 kids, what does the weekend look like?
Yeah, so there's 2 different scenarios. The one scenario is, you talk with any parent, and the kids at different stages of life. When the kids are young, you're going to the zoo, you're going to the park, you're doing things like that. When the kids are kind of in the middle years, you are taking them to karate, you're taking them to something like that. And then when they're in the teenage years, you're going to the sports events, you're doing all sorts of
Teaching them how to drive.
Teaching them how to drive, which I've been doing.
Yep.
In our weekends, we're doing all 3 because we have kids in each of those stages in life. And it is, when it's done right, it's like this elegantly choreographed ballet where people are going to different things perfectly timed pickups and drop-offs, etc. And I credit my wife for organizing it all. And then the days when my wife is sick, it becomes
Wheels are off.
It becomes like a scene from Animal Planet. It's every man for himself. It is just trying to keep everyone alive, and it's kind of semi-organized chaos.
So if this podcast had questions coming in and I could read them, one of them would say, does Pramod own a bus? How do you get the 9 of you around? Do you go out to dinner with the 9 of you, and how many cars go to dinner?
No, usually I only take the 4 or 5 of the ones who are behaving at any moment in time.
It's about half.
Exactly. No, we end up caravanning to most places because most of the time everyone's doing different things. So it's pretty rare when we're all going to the same thing together.
Well, you're doing a great job at home. Josephine, an even better job at home.
That's right.
And you're doing a great job at work. Thank you. I'm grateful for that. But we're going to do a moment of gratitude. I'm going to share with you an oversized mug. I'm grateful for you being on this podcast, Pramod, and everything you do for our clients every single day. So thank you.
Thank you.
I'll share my moment of gratitude, give you a second to think of yours. This week is Veterans Week, Veterans Day, but I think of it as Veterans Week. I am grateful to our veterans. When you're out there and you're putting yourself on the line and your life on the line for others, that takes a tremendous amount of courage and discipline. And I'm grateful for all of those veterans who have done that in history. I've been fortunate to work with this group called Catch a Lift, who supports wounded veterans, and the people in the organization who are so committed to helping the physical fitness of our veterans who've been wounded and trying to get them back on track so they're mentally on track and well-suited in life. I'm astounded every day by their commitment. What are you grateful for?
There are a lot of things to be grateful for. I have been very lucky in my life, in my career, in my family. If I had to pick something, I'd say it would be opportunity and the graciousness of others. Right. I would not be here today if it weren't for all of the opportunities that were given to my parents, to me, coming out of school, my first job, people taking a chance on me, and the graciousness of others, which is all the people who have given me a hand, who have mentored me and who've helped me. I try, now that I'm at the later stage of my career, I'm trying to pay it forward. But there are some amazing people. In fact, I'd say the majority of people, if not everyone at Capital Group, they're amazing people who are very gracious in terms of helping the people around them.
Yeah, and by the way, you have a lot longer left in your career. Let's be clear with that. And I do think you're right about just the graciousness and the quality of people. Our folks at Capital Group, they're committed. We have 9,000 associates every day committed to making sure we're improving people's lives through successful investing. It is others, the work of others that makes it so amazing for all of us. Thank you for being on this podcast, Pramod. Thanks for what you're doing for our clients. Thanks for joining us, and please subscribe to Capital Ideas on YouTube or wherever you get your podcasts. Have a great day.